Well, good morning and welcome to our weekly session of 10 minutes market update. This week there was a lot of events, basically, or it was mostly one event, but it had a huge impact on the market, basically because of the surprise that it did hold, and especially we're talking about, of course, the U.S. Inflation data, which was released basically yesterday, and it was a surprise because we can see clearly that disinflation is basically accelerating. And this is what basically the Federal Reserve wants to see. But at the same time, even though that, first of all, the CPI month over month declined by 0.1%, it was not expected to decline. It was supposed to be, or it was supposed to increase by 0.1%. And at the same time, we saw the core CPI also increasing less than expected. Expectations was about 0.2%. We got about 0.1%. And the most important one is the year over year. The CPI also slowed down to 3%. It was just supposed to go down to 3.2. And finally, the core CPI year over year also slowed down unexpectedly to 3.3, down from 3.4%. So the data basically continues to clear that inflation remains on the right track, and the Federal Reserve may need to actually cut the interest rates sooner. And this is what we've seen here. If you can see behind me, the Fed Fund futures is basically now fully pricing in three rate cuts, one in September and one in November and another one in December. While the Federal Reserve dot plot, of course, it showed just only one rate cut. But the data over the past few weeks, over the past few days, over the past also few months, is showing that the economy is slowing down faster than expected, which basically might force the Federal Reserve to act even sooner. Yesterday, we saw as a result, we saw the bonds rallied. 10-year yields is now down toward 4.2%. We saw the dollar index also taking a hit. We went all the way down to 104. Today is 104.50. We did some sort of recovered a little bit of yesterday's move in dollar index. However, this is the support that we've been waiting for, which is the 104.40, and it needs to hold in order for the dollar index to pick back up like some steam. Otherwise, I think this is still going to be the downside trend remains unchanged, especially if the data continues to show that the economy is slowing down, because the overall activity over the past few months has been showing a surprising data to the downside. The good news yesterday was the jobless claims. It did drop back down towards 222,000. The continuing claims also showed the first decline after 9 weeks of consecutive declines. 9 weeks of consecutive increases, and this is the first time we've ever seen 9 weeks since almost 2008. So that's another factor. Today, we will have another, of course, set of data, which is the PPI. And there's always a correlation between the CPI and the PPI. So today's expectations is showing just at least a month over month, a slight increase of 0.1%. We had also the core PCI, the core PPI is expected to rise by 0.2%. But the most important thing, of course, is the year over year, which is also expected to pick up again after a few months of consecutive decline. So any surprise again in today's data, the PPI is also expected to have another major impact. In addition to that, we have the University of Michigan Consumer Sentiment Report. And the most important one is not the actual report, the component of the 1 year expectations and 5 to 10 years expectations is going to have the most impact on the markets, because again, this is going to show how the inflation expectations actually going. So the 1 year inflation expectations is expected to go down to 2.9, down from 3, and the 5 to 10 years inflation forecast is expected to go or to remain stable at 3%. So any kind of surprise, again, just like what we've seen over the past few weeks, this is going to strengthen the idea that the Federal Reserve will actually need to move sooner, which I still believe that the Federal Reserve will need to move in September. As a result, of course, as I said, the dollar index went down, but we are holding at least the 104.40, 104.20 support area. And another interesting thing, and we've talked about this multiple times, that the Bank of Japan has been kind of intervening in very odd times. So the last intervention was during the holiday, and then a week after, they intervened right after the Federal Reserve decision and right after the closing bell of New York Stock Exchange. And yesterday, they actually intervened right after the data from the U.S. So the inflation data came out about 4:30 Dubai time, and the intervention from Japan came about, I think, just about like 5 minutes or after. Yeah, it was almost exactly at the same time of the release of the U.S. data. So that's kind of like interesting, which basically sent dollar yen all the way down to 150. 157.40 before it picked up back again like 159. There was still no official statement by the Bank of Japan, but there was a newspaper in Japan, I think it's called Nichi, and they confirmed, or they said, without mentioning the source of their news, but they said, they confirmed that the Federal Reserve basically, or not the Federal Reserve, the Japanese government and the Bank of Japan intervened in the market to stop the yen from falling. They kind of succeeded in stopping the yen, although the yen was basically almost close to 162. It wasn't at the high when that happened, but at the end of the day, they were able to push the dollar yen back lower towards 150, 157, 157.40. So the data that is the upcoming data, as I said, today is very important to keep an eye on. Also, we saw finally a breakout in gold. We broke yesterday another key resistance, which was supposed to be the formation of the head and shoulder. There was a lot of people talking about it on social media that there's a head and shoulder on gold, and it's with a bearish outlook. And the right shoulder was supposed to be at 2393 or 2393, but we broke out that level yesterday, and we continued all the way up towards 2420 and 23. And this is, of course, based on dollar weakness from one side, even though the inflation is going down, but there's some sort of fear in the market now that the Federal Reserve might be late. And as we said at the beginning of the week, the impact of negative news might actually change. Before, like a few months ago, bad news was supposed to be good news for stocks because this was basically increasing the ideas in the market that the Federal Reserve will actually have to cut rates sooner. So the market, or the stock market, used to rally on that. Yesterday, what happened was the opposite. And this is basically because of the data. What happened yesterday is right after the news came out, S&P, Dow Jones, NASDAQ futures spiked at least about 0.5%. However, after the market opened, we ended up down by 2.2% in 2.2% in NASDAQ. We ended up also down by almost 1% in S&P, while Dow Jones just basically added only 32 points. And what happened here is basically that the data is again showing some sort of signs that the Federal Reserve might be late, and they might actually rush to cut rates. And this increases the idea, or increases the chances, or increases the fears in the market that a recession might be underway. And this is why we saw the sell-off that we've seen. And this is also interesting that the impact from this miss in the data, or the unexpected decline, was the worst since the Federal Reserve started raising rates. So that is kind of like giving a little bit more signs, or at least an earlier sign, that equities might be reaching the top, and we might basically started to correct again. And this basically will be proven either correct or wrong in the next few days. So that's another thing. Let's talk about quick about the euro, which basically also managed to a breakout, or not a breakout. We did test the resistance almost at 109, but we trimmed these gains at the end of the day. At the same time, the British pound remains also strong. We did also post a new high since the beginning, or since at least July of last year. And for the time being, everybody needs to keep an eye on the upcoming data, which will continue to give us more signs. So keep an eye on the data today. I don't think so if there's anything else. But finally, I would say just crude oil, which despite the fact that we declined a little bit at the beginning of the week towards 84, that's Brent crude. Now we're actually pushing back up towards $86. So keep an eye on the data, make sure that you control your risk as much as you can, and be aware also of the interventions that happened in yesterday and happened also a few months ago by the Bank of Japan. These interventions will always come in unannounced. That's what intervention means. And you need to make sure that you have your stop in just in case something like that happened, especially if you're a buyer and not a seller when it comes to the Japanese yen. So I hope that I gave you some good information today, and I'll see you again next week on Monday.